Good morning, friends. Okay, so very quickly, who all are there today? Deepti Manchanda, Dheeraj Singh, and there's another Deepti. So we have two Deeptis. Then Satyendra, Gurpreet, Jyoti, Kaushal, Kuldeep Sharma, Manas Anand, Namitha, Paras, Rajendra, Swati, Yuvika, and UA. UA, who can you, in the chat box, can you please write your name? Okay, now before I start, how many of you are doing, are taking audit as the first paper? Classes. You have started with audit classes. Paras, Swati, and Jyoti. Okay, anybody else? Kuldeep and Dheeraj. Yuvika also. Namita. Okay, so a lot of you are doing audit as the, like starting with audit, right? Okay, so there is no problem as such, but as I have mentioned in the orientation, please ensure that before you sit for the audit exam, you must have gone through the FAR lectures. Okay, so you don't need a exam level preparation for FAR. You just need to go through it thoroughly to understand, that syllabus, the FAR syllabus, and before you sit for the audit exam. Okay, and so can I also quickly ask how many of you are chartered accountants? Manas, Paras, Rajendra, Kuldeep, Kaushal. 5 people? Okay. And have you recently qualified? How many of you are recent, like in the last 2 years? Okay. Anybody in the last 2 years? Okay. All right. All right, fine. So why I am asking these questions, I hope you know why I'm asking. Just because US auditing standards could be different from Indian, right? There could be some similarities, there could be differences, but right now we will only focus on obviously what is required for this exam, which is the US, right? So don't get into a comparison mode because that's going to be very harmful for you. Instead of doing good to you, it will do bad to you. And I'm saying this from past experience because, in the exam, when you are under pressure, clock is ticking, you have to answer the questions, right? In that pressure, if, one of the answer choices seem correct, because your mind is saying, I've read it somewhere, I've seen it somewhere, this is the right answer. But later you realize that that was the right answer as per the Indian, not as per US, right? So therefore, please don't do any comparisons while you are studying for CPA exams. Then once you become a CPA, you have your entire life to do comparisons. But right now, please don't do it. It is going to do more harm than good. Okay, so that is one word of caution. And because a lot of people are taking audit classes as the first subject, I'm going to go slow at least in the first couple of weeks. And then I'm going to maybe speed up. I'll ask you about the pace. Okay, if you all are happy with the pace, then I'll continue that pace. Otherwise, I'll increase or decrease as per the requirement. But first couple of weeks, I will go slow. And also, first couple of chapters, okay? When I say chapters, I mean A1. A1 is a chapter, A2 is a chapter, okay? And then inside A1, there are modules. Inside A2, there are modules. So those are called modules, okay? So when I say chapter, I mean A1 to A6, 6 chapters in the syllabus. And then, some chapters have 10 modules, some have 8 modules, some have 11 modules, etc. First couple of chapters are going to create a base for us, to go through the remaining syllabus. So first 2 chapters will be kind of fundamental, foundational, and we will come across many terms in the first 2 chapters those terms will actually be discussed in detail maybe in the 3rd or 4th or 5th chapter. Okay, so we will go through a lot of terms, but the details will come later. in later chapters. Okay. So just keep that in mind, that we are going to cover the details when we reach there. Okay, so I'm sharing the screen. Okay, can you all see my screen? Yes. Okay, great. So this is A1 audit, AUD1 or A1 first chapter, and this has 11 modules. So it's a pretty big chapter. As you can see, the last module starts at page 93. So overall, I think this chapter has 102 pages. Yes. If you see here, this is the last page, 102. Okay, pretty big chapter. Now, before I start, I also want to request one thing, that if you have A4 sheets, then please get some A4 sheets before I start. If you don't have A4 sheets at home, then maybe you can use a notebook. Okay, please make a new notebook, a new register for audit. Right? If you don't have that also, then make sure that you buy it before tomorrow's class. And if you have A4 sheets, then that would be the best. Okay. And just one more thing, because these are weekend classes, I don't take it from my office. I take it from my home office, So existing students probably already know this. For new students, just one this thing, that I have a furry friend at home. I have a dog. So he's always around me. Okay, he's most attached to me in the entire family. He's most attached to me. So wherever I am, he's generally in that room. He sits next to me. So whenever I take my classes, also he's normally sitting next to me. Okay, so what happens is he does not create any disturbance. Uh, but if the bell rings, then instinctively he barks. So that just for 2-3 seconds or 5 seconds, you might hear a bark once in a while. Maybe in a 4-hour class, that might happen once, and that also not on a daily basis, not on every class basis. Sometimes it might happen that the bell rings during the class and he will instinctively bark. Okay, so please bear with me on that. So yeah, let's get started. Any questions before I start? Is there a class tomorrow considering Jan 26th? I think as per the schedule, there is no class tomorrow. Let me just check 1 second. No, so there is no class tomorrow as per the schedule. And also, yes, one more thing, there is no class in the coming weekend. Okay, the the 1st Feb, 2nd Feb weekend. Okay, there is no class. After that, it's going to become regular. Then there is no stop. From 8th of Feb, it's going to be continuous classes, no stop, except if Holi falls on a weekend. I don't know the exact Holi date right now. If Holi falls on a weekend, then we might have that day off. But otherwise, there is no off from 8th Feb onwards. Okay, so tomorrow there is no class, and and next weekend there is no class. No FAR class also on 1st and 2nd. 1st and 2nd, there are no classes uh, because I don't know how many of you how many of you know, how many of you are attending. There is the World Forum of Accountants happening in Delhi, and I think it's the first time it's happening in Delhi. So it's a very good opportunity to network, to explore, avenues, and if you want to go abroad, then a lot of foreign institutions will be there. the other counterpart bodies of ICAI, of other countries, they will be there. It's going to be a mega event happening in Dwarka in Delhi. So if you have not yet registered for it, or you were not aware of it, you can go check World Forum of Accountants on Google, and if the registration is still open, you can register yourself, right? So it's a 3-day event, 31st, 1st, and 2nd. So therefore, there will be no classes on 1st and 2nd. Okay. All right, so let's get started. Audit 1, 11 modules. First module, professional standards. And what you will do with those A4 sheets, I will tell you. Okay, just have those A4 sheets ready in front of you, and maybe pens of at least 2 colors, right? Blue and red, or black and red, at least 2 colors. Okay. And if you have a green pen, maybe you can use 3 colors, and I will tell you later. Right now, let's get started. Okay. So professional standards, the auditing and attestation section tests audits of issuers, non-issuers, governmental entities, not-for-profit entities, employee benefit plans. Now, what is an issuer? We will see later. What is the definition? Who are non-issuers? Again, we will see later. Governmental entities, there's a whole chapter on it, right? Not-for-profit entities, also there are modules on it. Employee benefit plans is not covered in detail. There is just a passing reference. Okay. So we will, as I said, we will talk about these aspects in detail later. Okay. Right now, just absorb what is, what is there in this module. Just keep absorbing. Just sit back and listen. Okay. When you need to write, I'll tell you. And when we go into details, of course, we will discuss in detail. So audit paper, this paper basically tests audits of issuers, audits of non-issuers, audits of governmental entities, audits of not-for-profit entities, and audits of employee benefit plans. Obviously, it's an audit paper. It will test you on audits of these entities. Okay. But it will also test you on other things. In addition to audits, this section also tests other types of engagements that an accountant may be called upon to perform, such as accounting and review service engagements. Accounting and review service engagements. You don't have to highlight these things. Okay, I am highlighting, but you don't have to highlight because there is a whole table here, down here, where we will talk about these. So an accountant may be called upon to perform such as accounting and review service engagements, attestation and assurance engagements. Each engagement requires the accountant to follow the applicable ethical guideline and standards for that engagement, right? So if you're doing an audit, you will have to follow the auditing standard. If you're doing a accounting and review service engagement, then you have to follow those standards which are for accounting and review services. If you're doing an attestation assurance engagement, you will have to follow those standards. So for each engagement, again, each engagement requires, okay, the word is each engagement. Each engagement requires, and requires means mandatory. Okay, the word require and must in auditing means they are mandatory. Okay, and we will look at that also. Which word means what? We will look at the hierarchy. So each engagement requires the accountant to follow the applicable ethical guidelines and standards for the engagement. For example, an audit engagement requires auditor to perform the audit in accordance with GAS. So if it's an audit engagement, you are going to follow GAS. What is GAS? Generally Accepted Auditing Standards. These engagements and applicable standards will be covered in more detail in later modules. Below is an overview of the standards and guidelines that will be tested in this section. So it is an overview. We will cover the details later. Let's look at the overview right now. First one, if you are doing an audit, then the standard or the guideline is there in the statements on auditing standards called SAS. Okay, statement on auditing standards called SAS. Also, it is covered in Public Company Accounting Oversight Board Auditing Standards, PCAOB, Public Company Accounting Oversight Board, PCAOB Auditing Standards, PCAOB AS. So there is SAS, SAS, and then PCAOB AS. Which one is applicable for audits of non-issuers? You will follow SAS. For audits of issuers, you will follow PCAOB AS, right? Who has issued these statements? Standard setting body. AICPA Auditing Standards Board has issued SAS. AICPA Auditing Standards Board, ASB. Auditing Standards Board is also called ASB. The short form is ASB. So AICPA ASB has issued SAS and PCAOB has issued PCAOB AS. Public Company Accounting Oversight Board. Okay. Section reference, you don't have to memorize it because they generally don't test you on the on these. But yeah, it's just good to know. I'm not highlighting it. You don't have to memorize it as such. Now the description, SAS provides generally accepted auditing standards for the audits of non-issuers. In addition, SAS provides guidance for other services such as review of interim financial information and letter to underwriters. Okay, again, see, audit is a very heavy subject, and every paragraph has some terms that right now you may not know, but as I said, we will cover it later. You may not know what is a non-issuer. You may not know what is a review of what is interim financial information. First of all, what does it really mean? Does it mean quarterly financials? Can it be 6 months? Can it be a half yearly financial? Can it be anything other than quarterly or half yearly? Right? So what does interim financial information mean? What does review mean? Right? Is review different from audit? All that, what is a letter to underwriters? So it's technically very heavy, right? And this is just the beginning. Every line, every paragraph will have something. So just right now, as I said, just absorb these things, whatever is there. We will cover all this in detail as we go. And slowly it will unfold. Slowly it will unfold, okay? Audit. So audit of non-issuer covered by SAS, issued by AICP Auditing Standards Board. SAS not only covers audits, standard for audits of non-issuers, but it also covers guidance on review of interim financial information and letters to underwriters. Applies to audits of annual historical financial statements of non-issuers. Now again, audit of annual, first of all, audit of annual, right? And second, it is historical financial statements. So when we use the word audit, we normally use the word audit in the context of historical financial statements, not in the context of future financial. For example, we don't use the word audit when we talk about prospective financials or forecasts or projections. We don't say we have audited a projected financial statement, or we have audited a forecasted financial statement. No, never. That's a wrong statement. Okay, so the word audit is used in the context of historical financial statements, and the word audit is used in the context of annual financial statements, not quarterly, right? But you will say, so here it says interim and it says review. Exactly, it says interim, that is why it says review. It does not say audit of interim. Yes, it is covered by SAS, that's a different matter. It is covered by SAS, that's a different matter. But I am saying the word audit is used in the context of annual financials. The word review is used in the context of interim financials. Okay, so two things you have to keep in mind whenever we are talking about annual financials and historical financials, annual historical, then we are using the word audit. Then also applies to special reports like we saw, this letter to underwriter and all. So this is a special report, right? But of non-issuers. And then interim financial statements. Now look at this, interim financial statements where the annual financials have been audited. Only in those cases SAS will apply, where the annual financials have been audited, annual financial statements have been audited, and now the client has called you to do a review of their interim financial statements. The annual were audited maybe by some other CPA or CPA firm, and they have called you to perform a review of the interim financial statements. Or you may have only done the annual audited, right? The audit of the annual financials, and now the client is asking you to do the review of interim financials. The point is that if annual were audited, then SAS will apply to this review. So the question is, if annual was not audited and we have to do a review, then which standard will apply? So just hold on to that thought. We will cover that in the next page. Okay, that if annual is not audited and we have to do a review, then which standard will apply? Right now, if annual was audited and we have to do a review of the interim financials, then SAS will apply. Okay, clear? And as you see here, it's non-issuers, non-issuers, non-issuers. That means SAS is just not applied to issuers. For issuers, we have the Public Company Accounting Oversight Board auditing standards. Now let's read this. PCAOB auditing standards provide generally accepted auditing standards for the audit of issuers. In addition, PCAOB AS provides guidance for other services such as review of interim financial and letters to underwriters, right? So it's the same thing, but for issuers. Again, audit of annual historical financials, but of issuers, special report of issuers, interim financial statements of issuers. Now here, why have they not written in bracket where the annual financials have been audited? Is it by mistake? No, it is not by mistake. Why have they not written this in bracket, this part? Where the annual financials have been audited, why is that missing over here? Because anybody? Correct, exactly. Exactly. So audit is mandatory for issuers, so they have to get their annual financials audited, right? They have to get their annual financials audited as per anybody who has done FAR will know this. Who makes it mandatory? Who makes it mandatory for audit of issuers? I mean, who makes it mandatory for issuers to get their financials audited? Annual financials? Correct, Kaushal. It's the SEC, Securities and Exchange Commission. So when you did in FAR, when you did SEC, right? SEC means issuers means those who are listed with the Securities and Exchange Commission, right? Okay. So SEC makes it mandatory that the annual financials have to be audited by a CPA or a CPA firm. So that is why that bracket thing is missing here, because there is no question of if you have to get your annual audited, and obviously if your annual is audited and you're doing an interim financial review of interim financials, then you will follow PCAOB AS. Just one second. Okay, guys. So again, annual, historical, yeah. Okay, and issuers. All right, let's proceed now. GAGAS, generally accepted government auditing standards, GAGAS, issued by the Governmental Accountability Office, GAO. GAGAS provides guidance for audit of government organizations, programs, activities. So government organization, government programs, government activities, and of entities that receive government funds. So even a private sector organization may be required to get an audit done under GAGAS if they have received government funds, okay, federal financial assistance. So entities that receive government funds, it's applicable to them as well. Finally, financial or performance audits. So here we are not just talking about financial audit, we are also talking about something called performance audit of government organizations, programs, activities, and of entities that receive government funds. Okay, and we will look at the details later. Okay, what does government fund mean, right? Federal financial assistance of how much amount? Even if they get $100, will it be applicable to them? No, there is a threshold. Okay, so we will look at that. So GAGAS will become applicable to government audits of government audits. Okay. Next. Statements on, this is for other engagements. Statements on standards for attestation engagements called SSAE. State standards for attestation engagements. Okay, issued by AICPA. SSAE provides guidance for attestation engagements like examination, review, agreed upon procedures, reporting on a agreed upon procedures report on a subject matter, or an assertion about a subject matter. That is the responsibility of another party. Okay, again, there are modules on these, separate modules covering all this. SSAE will be applicable for these engagements if you are called to perform an examination or a review or an agreed upon procedure on a subject matter, directly on the subject matter, or agreed upon procedure on an assertion about a subject matter. Okay, there is an or here. That is the responsibility of another party. That is the responsibility of another party. And statements on standards for accounting and review services. SARS, issued by AICPA Accounting and Review Services Committee. SARS provide guidance for unaudited financial statements or unaudited financial information of non-issuers. What is covered here? Preparation engagements, compilation engagements, review of historical financial statements for non-issuers, and preparation or compilation or of pro forma financial information and forecasts of non-issuers. That means, now see, the word review is here, the word review is here, and the word review was there in SAS also. Correct? So the word review is everywhere. Now, which one will be applied? Let's understand it one more time. If the annual financial statements are audited and you have been called to review the interim financial information, then SAS will apply. Then SAS will apply. Okay. Let's go to the next page. If annual financial statements are not audited and you have been asked unaudited, if annual financial statements are not audited and you have been asked to perform a review of the interim financials, then you will follow SARS. Is that clear? You are doing a review of historical financials, but the annual financials are not audited. Then you will follow SARS. If annual are audited, you will follow SAS. What is this review under SSAE? This review is not of financial statements. See, here it was review of historical financial statements. Here it was previous page. It was review of financial information. Right? Basically interim financial statements. So review of interim financial statements. Whereas the SSAE review is a review on a subject matter or an assertion about a subject matter, not on financial information or financial statements. So if you are reviewing something else, okay, then it is SSAE. If you are reviewing the historical financials where the annual is audited, then SAS. If you are reviewing historical financials where annual is unaudited, then SARS. Is that clear? And SAS is applicable to non-issuers. SARS is also applicable to non-issuers. For government, there is GAGAS. For issuers, there is PCAOB. Clear? Now let's move to guidelines. So whatever we did so far were standards. Now there are some guidelines also. Code of Professional Conduct issued by AICPA. And yes, you have to remember who issued what. Which one is AICPA? Accounting and Review Services Committee, SARS. SSA is AICPA. SAS is AICPA Auditing Standards Board. And which one is just AICPA? SSAE is just AICPA. Code of Professional Conduct is just AICPA, not any board or committee. Okay, so you have to remember, see, there is a lot of memorization involved in audit. Okay, fortunately or unfortunately. Fortunately for those who are good in memorizing things, unfortunately for those who are not, right? But yes, you have to memorize a lot of, a lot of things. AICPA Code of Professional Conduct provides members with guidelines for behavior in the conduct of their professional affairs. In addition, it provides assurance to the public that the profession intends to maintain high standards and to enforce compliance with these standards by its members. So it is applicable to members of AICPA, the Code of Professional Conduct. Okay. And again, we will see in detail that members are also members in practice, members in business, members in employment, all that we will see. Next is statements on quality control standards. Statements on quality control standards, SQCS, issued by, again, AICPA. SQCS provides guidance to CPA firms about a quality control system. A quality control system consists of policies and procedures designed, implemented, and maintained to ensure that the firm complies with professional standards. And not just professional standards, they also comply with appropriate legal and regulatory requirements, and that any report issued are appropriate in the circumstances. So SQCS is not engagement specific. See, the standards are engagement specific. You are going for an audit of non-issuer, you will follow SAS. You are going for an audit of an issuer, you will follow PCAOB-AS. You are going for a review on a subject matter, you will follow SSAE. You are going for a review of interim financials where annual is audited. Annual is audited. You will follow SAS. You are going for a review of interim financial where annual is not audited. You will follow SARS. You're going for an examination engagement, you will follow SSAE, etc. So what I'm trying to say is that for a particular engagement, you will follow a particular standard. So standards are engagement specific, whereas code of professional conduct and system of quality control quality control standards are not engagement specific. They apply to the code of professional conduct apply to the member, like they apply to the member. Whether that member is going for an audit or a review or an examination engagement or an agreed upon procedure engagement, it will apply to that person. Similarly, SQCS, quality control standards, will be applicable to the firm. That means the firm must have some policies and procedures in place to ensure that yes, when we are going for an audit, we are following the appropriate standard. When we are going for a review, we are following the appropriate standard which is applicable to this review. We are issuing reports based on that standard. So if we are doing a review, we are issuing a review report. If we are doing a compilation, we are issuing a compilation report, because every report has a different language. We are issuing the correct report for the correct assignment, right? So, and we are also following the legal and regulatory requirements. So it applies to the firm as a whole. CPA firms providing auditing, attestation, accounting, review services. So it is applicable to CPA firms. And this one is applicable to members of AICPA. And those were engagement specific. Okay, clear? Now, this is heavily tested area. This table, first 2 pages of the book, heavily tested area. Okay, that's why I went so slow. But as I said, we will cover the details later. Now let's look at the auditing hierarchy, GAS hierarchy. There are 3 levels of audit guidance: most authoritative to the least authoritative. Which is the most authoritative audit guidance? The SAS and the PCAOB-AS. And this is audit guidance. So SAS has the highest authority. Auditors should use professional judgment in applying SAS or PCAOB-AS to a particular engagement. Professional judgment is something that we are going to use throughout the audit, right? And and as you can see here, even before going to the audit, we are using professional judgment to determine which standard should be applicable to this engagement, right? So please, in the A4 sheets, please, in one of the A4 sheets, give a heading professional judgment. Where all does the auditor use or CPA use professional judgment, we will make a list as we go through the syllabus, because it can be asked. So give a heading professional judgment and make this your first bullet point in that page in applying SAS or PCAOB-AS to a particular engagement. Okay. In fact, just give me one moment, please. So let me quickly show you also. So this is A1, page 5, module 1. Let's say you make this is your A4 sheet. Give the heading professional judgment. Write the point in applying SAS or PCAOB AS to a particular engagement. And then write here within bracket A1, M1, page 5. Just for your future reference. Then next item we will see when it comes. So this way, by the end of the syllabus, you will have a ready 1 or 2 pages. Where all does the auditor use CPA use professional judgment, right? So these kind of A4 sheets are going to tremendously help you before the exam. So please make it diligently. Okay. Then comes, so use professional judgment in applying SAS or PCAOBAS to a particular engagement. Be prepared to justify any departure from the presumptively mandatory requirements. Presumptively mandatory requirements. We will just see all this, what this means. So one word is mandatory. And then there is something called presumptively mandatory. Okay. So when I said the word required, wherever required is written, auditor is required to do this, auditor is required to do that, that means it is mandatory. You have to follow that. Okay. It is mandatory means it's an unconditional requirement. Unconditional requirement. And the word must also means the same thing. Auditor must do this. So that means it's mandatory. Presumptively mandatory is should. The auditor should do this. Okay. Now, as you see here, if somewhere it is written in the auditing standard that auditor should do this, that means it's a presumptively mandatory requirement. Can the auditor depart from it? Yes, auditor can depart from it. There can be departures that auditor did not do this. It was written auditor should do this, but auditor did not do this. So there is a departure from that requirement. Auditor did not fulfill that requirement, but the auditor, if that happens, the auditor must be prepared to justify why they did not follow that. When it comes to required and must, it is unconditional. Here it is presumptively mandatory. You can depart, but you have to justify your departure. Specific language is used within the standard to clarify the auditor's level of responsibility. Must or is required indicates unconditional requirement, which must be followed in all cases in which the requirement is relevant. All cases. Should is a presumptively mandatory requirement, which must be followed in all cases in which the requirement is relevant, except in rare circumstances when departure is permitted if there is appropriate justification. And not just a justification, comma, performance of sufficient alternative procedures. Okay, fine. It said you should do this, you should do X, you did not do X, but you have to perform sufficient alternative procedure. Instead of X, you perform Y. And thorough documentation. Also, there are 3 requirements. If you are departing from a presumptively mandatory requirement, there are 3 things you need to do. First, you need to justify why you did not do X. Okay. Second, you have to perform something else in place of X. Sufficient alternative procedure. And third, you have to document this whole thing. You have to document your departure, that we did not follow this step. You have to document the justification why you did not follow this step. You have to document that instead of X, we have done Y. Right? And this is how Y also satisfies the requirement, because it says sufficient alternative procedure. So this is how Y is sufficient. We need not do X because we have done Y, which is also sufficient. It's a sufficient procedure. Okay. So there are 3 requirements if you are departing from a presumptively mandatory requirement. Then comes may, might, or could. Auditor may do this. Auditor might do this. Auditor could do this. They are just explanatory material that does not impose a professional requirement for performance. This is totally discretionary. You want to do these, you do. You don't want to do, you don't do. Wherever it is written, auditor may do this. So it does not impose a professional requirement for performance. Okay. But must or required is unconditional, should is presumptively mandatory. Then comes the next level, the interpretive publications. Interpretive publications are recommendations regarding how SAS should be applied in specific situations. They are not considered to be auditing standards, right? So they are not auditing standards, they are just recommendations. Again, although they are just recommendations, auditors should consider the guidance provided by these publications in performing an audit. Again, see here, be able to explain any departures and how compliance with the standard was otherwise achieved. That if you did not follow this, then how did you achieve what you were required to achieve? How the compliance with standards was achieved. Examples are auditing interpretations of gas, exhibits to gas, auditing guidance provided in AICPA audit and accounting guides, AICPA auditing statement of position. So these are all interpretive in nature, right? You have to remember this list because they can ask you question. They can give you 4 options and say which one out of these is an interpretive publication or which one out of these is not an interpretive publication. So maybe they write here exhibit to gas. Exhibit to gas. One option is statement of position. One option is auditing interpretations. And one option is SAS. Which one out of these is not an interpretive publication? Answer is SAS. SAS is not an interpretive publication. The other 3 are interpretive publications. So, you have to remember this. Okay. Then finally, the least authoritative is other auditing publications. They have no authoritative status, but may be helpful to the auditor. Should consider the guidance provided by these applications, and here also should be able to explain any departures and how compliance with the standards was otherwise achieved. Okay, so here, again, you have to explain any departure. So basically the point is that if you are doing an audit, you must consider everything. You must consider the SAS, you must consider the interpretive publications, you must consider other auditing publications. There is so much literature there to help you in doing the audit. Just keep following what these publications are saying. Just follow everything. Do everything that they are saying, and there will be no question mark on the audit. Why I'm saying this is because there is a lot of question mark on audit, happening off late, right? And especially in the Indian environment, there's a lot of that happening right now. With NFRA coming into the picture, lot of questions being raised, right? So if you are doing an audit, follow everything. If you're not following everything, you should be able to explain the departure, how the compliance with the standard was achieved. And if you have departed from should criteria, then of course you have to perform an alternative procedure and also document it. Of course, justify why you did not, perform alternative procedure, and also document it. And of course, must or is required, you cannot depart. It is unconditional. Okay, so remember this hierarchy. On the top is SAS or PCAOB. SAS is applicable to non-issuers, PCAOB AS is applicable to issuers. So on the top is SAS or PCAOB. Then next is interpretive publications, where you have the auditing interpretations, the exhibit, the accounting and auditing guide, and statement of position. And then you have other publications like auditing articles in Journal of Accountancy or other professional journals, AICPA, CPA letter, continuing professional education materials, textbooks, other auditing publications. So we are done with module 1. It was a very small module, but heavy, right? Now audit engagements, module number 2. And yes, one more thing, that we are going to do MCQs, in the following weekend. So whatever I am covering this weekend, I will cover the MCQs of those topics in the following weekend. Of course, we don't have a class in the following weekend this time, but going forward, I will cover the questions also. Paras, most to least authoritative. Most means you have to, as we saw here, most means you have, see, the must requirement is in the most authoritative part, right? That means you have to follow it. You don't have a choice. But as you keep going down, there is, the authority reduces, because interpretive publications don't have an authoritative, other auditing publications don't have any authoritative status, right? So most to least means that only, that what authority does that literature have. Authority, the word authority is not used only in the context of human beings, that so and so person has authority, but it is also used in the context of these standards and guidance, in the context of documents. Like we say, Constitution of India has the highest authority. That means nothing is above it, right? That is the word authority, authoritative, what it means here. Nothing is above it. That means other publications are not above SAS. SAS is above other publications. SAS is on top. It's the most authoritative in the context of audit. Only in the context of audit we are having this discussion, right? That in the context of audit, SAS has is the most authoritative for non-issuers. PCAOB-AS is the most authoritative in case of issuers, and then you keep going down, right? Not value, not value. Of course, value, but authoritative here means you have to follow it. You have to abide by it. Okay. Okay. And that's why we saw here that if you are not abiding by it, there are 3 requirements. Correct? There are 3 requirements. First of all, you can depart only in rare circumstances. Very rare circumstances you can depart. So it is not on your wishes, on the auditor's wishes or whims and fancies, that I don't feel like doing this step, I am not doing this step. No, it's not such a casual matter. It's a very serious matter, right? Your license can be revoked. You can be given a fine, penalty. You can be debarred from the profession. So it's a very, very serious matter. It's not on the wishes of the auditor that, oh, I'm not feeling like doing this step, I'm not doing this step. In the rare circumstances, when for some reason, rare circumstances, you are not able to do a particular step, then there is a proper justification to it. You will be able to justify if you are, if you are called upon to justify. If somebody questions you, your peer review, in a peer review, or we will see there are multiple levels of reviews, right? There is a secondary review first. So not just the signing partner will review what work the team has done, but there will be a secondary review. Then peer review is there, quality review is there, right? So all of that, it's a very serious matter. So in rare circumstances, you can depart. You have to give a justification. You have to perform sufficient alternative procedures, and you have to document it. Why? Because it is the most authoritative. It comes under the first category of SAS. But in the last category of SAS, I mean last category of not SAS, but auditing, guidance, least authoritative. Those 3 points are not here, right? Of course, it says you should be able to explain any departure, but it does not say you have to perform alternative procedure. You have to document it, and it does not use the word rare circumstances. Okay, it has no authoritative status. Now, is it clear? It is, yeah? Clear now? Other auditing publications may be ignored. No, not totally ignored. It should be considered. The word is considered the guidance. Right? So do not ignore. Consider the guidance and follow that. If you're not able to follow, you should have an explanation why you could not follow. Right? And without following also how you achieve but they don't have an authoritative status. Okay, now this will become clearer as we go, as as we start doing the actual, from chapter 3 onwards, you will see that we will actually get into the field work, how audit is first planning, what planning we do, then what strategy we make, and then how do we actually go and conduct the audit, right? So we will cover all that. As I said, first 2 chapters are just foundational. It's giving you an idea about what audit is all about. Okay. Shanku, issuer, non-issuer, the exact definitions will come later, but for now, you can consider issuer as a listed company. Issuer means a listed company, right? That means basically, in simple words, those who are listed with the Securities and Exchange Commission, listed with SEC. Okay, so basically these are public companies. Public companies, listed companies, they are called issuers. And who has to list with SEC? Those who are listed with a stock exchange. So if your company is listed with New York Stock Exchange, you have to list yourself with Securities and Exchange Commission. If your company is listed with NASDAQ, you have to list yourself with Securities and Exchange Commission. You're listed in any stock exchange, you have to list yourself with SEC. So they are called listed companies, right? Also referred to as issuers. Non-issuers are those who are not listed, private companies or non-public companies, right? But exact definition we will see later. The exact technical definition we will see later. Right now, you can just think of it of issuer as a listed public company and a non-issuer as a private company. Okay, clear? Shall I proceed? Audit engagements, module number 2. And it's a 9 to 12:30 class, 3.5 hours. So I will give you a break around 11 o'clock. Okay. Around 10:45, 11 o'clock. Okay. Audit process overview. So there are some general principles that you have to follow during the audit process. What are the overall objectives? What are the documentation requirements? What are the communication requirements? and what are the quality control standards that you need to abide by. What all things you need to document, who all you need to communicate with. You need to communicate with management, with the board of directors, with the audit committee, right? And also your report is a communication. Your report, because your report is in writing. When you issue the audit report, it will be in writing. That is also a communication to whoever you are addressing the report to. That means if you're addressing the report to the members of the members means shareholders, basically, right? Of the entity, then you are communicating to them, right? And why am I saying if you are addressing it to the shareholders? Because we will see later, you can also address it to other than shareholders. We will see that. But whoever you are addressing it to, you are communicating with them. So your report is also a communication. But apart from that, you also need to communicate certain things to management, communicate certain things to the, there will be a term which we will see, those charged with governance, TCWG, those charged with governance. Who is governing this company, right? So you have to communicate with them, right? Certain matters. Then comes, so this is applicable, right? General principles applicable to the audit. But even before you accept the engagement, even before you accept, a company has approached you that we want to get our financials audited. Now you have to first think, should I even take up this assignment? Right? Because why you have to think about it? Because there is an auditor, a CPA associate, should not associate with financials which are financials that are false, fraudulent, deceptive, or misleading. You should not associate yourself with financials that are false, fraudulent, deceptive, or misleading. So if you think, and also audit, a CPA should not associate with a client whose management lacks integrity. So if you think that the management of this company is lacks integrity, you should not accept that engagement. If you think that the financials are false or fraudulent, deceptive, or misleading, you should not accept that engagement. So you have to do some work. How will you know, or how will you kind of assess that these financials seem to be false, fraudulent, deceptive, misleading? So you have to do some work to even reach this point. Unless you know from other sources that this company is of low integrity, the management is of low integrity. There have been instances earlier, it was in the news, it was in the public domain, right? If that is the case, then without doing anything also, that no, I cannot take up this engagement, I cannot accept this client, right? But otherwise you will have to do some work to even reach this point, to form an assessment that the management seems to have low integrity, or the financial seems to be false, fraudulent, deceptive, misleading. I should not accept this engagement, right? So even before accepting the engagement, there is some work involved. And also, yes, very important thing, are you independent of the client? Independent, because independence is a requirement in audits. It is a requirement, means it is mandatory, unconditional requirement. You cannot accept an engagement where you are not independent. What does independence mean? We will look at that later. But you need to be independent of the client. In simple English, the exact auditing definition we will see later. But in simple English, what does independence mean? Independence means you are not subordinate to the wishes or commands of others. You are not subordinate to the wishes of others or commands of others. That means you are independent. That you will take your own decisions. You will form your own judgments. You will decide. You have the discretion, not someone else. Okay? So in simple English, independence means this: you are not subordinate to the wishes or commands of others. Correct? Exact definition we will see. It's a very important topic, independence. So ethics and independence you will see, terms of the engagement you will see, and then you will accept the engagement. Right? If everything is fine, you will accept the engagement. Then once you have accepted the engagement, you will do the planning, strategy, and strategy, by the way, is part of planning. Okay, a lot of students think that strategy is a separate thing, planning is a separate thing. See, planning including strategy. It clearly says here, planning including strategy. So strategy is part of planning. Then you will determine the materiality. Okay, again, what is material? We will see later. You will determine materiality. You will do risk assessment procedures. Okay, you will try to evaluate what are the risks. Okay, understand. So understand the entity. You will understand the entity and its environment to do a risk assessment. Is there any risk involved here? And understand the internal controls. Okay, how strong the internal controls of the company are to prevent any material misstatement from entering into the financials, right? Then you will identify and assess the risk, and then you will respond to the risk. So you will maybe extend your procedures, you will do some additional procedures, etc., right, to respond to that risk. And risk here, just to give you an idea, we are talking about. So first of all, what does risk here means in the context of audit? In the context of audit, risk means that there could be, first of all, that you could end up giving a wrong opinion. That's the biggest risk, audit risk, that you could end up giving a wrong opinion. That means financials are not showing the correct picture, right? Financials are not showing the correct picture, but you end up giving an opinion that financials are showing the correct picture. Okay, I'm using very simple English language right now. We will obviously look at the auditing language, but very simple English language, financials are not correct, but you end up giving an opinion that financials are all good. So that is a risk you are facing, that what if I am not able to find out the misstatements. There are misstatements in the financials, but I end up giving an opinion that financials are not materially misstated. Okay, so giving a wrong opinion is the risk. And wrong opinion here means something is not right when you are saying it is right. Right, so that is where we talk about risk. And for that, we will see later there is a formula. Audit risk is equal to IR into CR into DR. That means inherent risk into control risk into detection risk, right? There is an inherent risk in this company. The control risk is also high. That means they don't have controls in place. Okay. So the inherent risk is high. They don't have controls in place. And there is a detection risk also that you may not be able to detect. So it's a combination of three things which leads to an audit risk, which is basically the risk of giving a wrong opinion. If the inherent risk is also high, the control risk is also high, detection risk is also high, there's a huge audit risk. Okay. So therefore, you have to understand the entity and its environment. You have to understand the internal controls that are there in the company. You will have to identify and assess the risks, and you will have to respond accordingly to that risk. What do I do now? Okay. And let me also tell you that revenue recognition is considered to be a high risk area in every audit engagement. Revenue recognition, that means that the company might be trying to overstate its revenue. They are trying to show revenue more than what it actually is. Maybe their revenue is just $1 million. They are showing double 2 million. Just example. They are showing double $2 million, right? So, revenue recognition is considered to be a high risk area in every audit engagement. And second high risk area in every audit engagement is override of controls. Override of controls. Controls could be there. Controls are there, but the top management overrides them because they have authority in the organization. They sometimes override the controls, right? So very simple example, you have a user ID and password, right? User ID and password. The CFO, let's say not CFO, let's say your boss comes to your workstation and says, what's your password? He sits on your chair, sits on your system, and you are standing next to him, right? He's sitting on your chair and you are standing next to him and he's saying, what's your password? Will you say, no, I will not give you? Will you say, I will not give you? He's your boss. So, there can be compromises. So your boss is asking, you will give the password, he does something, right, in your system. Now the system has recorded that you have done it because your user ID and password has been used. Okay, I'm just giving a very, simple example here, but we will see later. So there could be override of controls, right? Control is there. There is a user ID password assigned to every employee in the organization, but somebody is overriding it. So those kind of things, then perform the procedures and obtain evidence. So then you do test of controls. If applicable, then you do substantive testing. Again, very important thing here, why if applicable is written next to test of controls, why if applicable is not written next to substantive testing? Because it is not mandatory to do test of controls in every audit engagement. You will do test of controls only if it is applicable, right? Technically speaking, practically speaking, you will do test of controls in 99% of your audit engagements. But yeah, technically speaking, if you go through the standard, we will go through it together. We will see that test of control is not mandatory. It is mandatory only in only if certain circumstances are there, then it becomes you have to do test of controls in those cases. Otherwise, it is not mandatory in every audit engagement. But substantive testing is mandatory in every audit engagement. That means, let me ask a question. Can I complete an entire audit just by doing substantive testing? Can I complete an entire audit just by doing substantive testing? I'm asking you, yes or no? I went for an audit, I did substantive testing and issued my report, audit report. Is it fine? Can I do it? Can I do it? Yes. I can complete an entire audit just by doing substantive testing and no test of controls at all. Can I complete an entire audit just by doing test of controls? Just do test of controls and issue your report. Can we do that? No, we cannot do that, right? So we cannot complete an audit just by doing test of controls. We have to do some amount of substantive testing. Even if the controls are extremely good in the organization, very, very strong internal controls are there. Absolutely strong internal controls are there. You test the controls, you see that everything is fine, but still you cannot issue your report. You have to do substantive testing. But if in a particular company, internal controls are very, very weak, extremely weak, you say, I'm not going to rely on the controls because they are weak. I'm just not going to rely on the controls because they are extremely weak. Give me your entire ledger, give me all your vouchers, give me everything. I will do substantive testing. I will go through your vouchers. I will go through your ledgers. I will do your, confirmation. I will take confirmation from the bank. I'll take confirmation from your accounts receivable parties. I will do all the substantive testing. Possible? Yes, it is possible. Okay. So just finishing an audit just by doing substantive testing, yes, possible. Finishing an audit just by doing test of controls, not possible. Okay. Next comes, now you have done your audit, you have done the planning, you have done your risk assessment, you have responded to the risk, you have done your procedures, obtained evidence through test of controls and substantive testing as applicable, and then you have formed your, to form your conclusion, you will also have to evaluate the audit result, whatever evidence you obtained, right? So evaluate that, then also evaluate some subsequent events, then take a management representation letter and ensure that you have also fulfilled the quality control standards on this engagement. And finally, once you have formed your conclusion, report on the audited financial statements, and in case there are other reporting considerations, then report on those, right? For example, reporting on compliance, reporting on ICFR, internal control over financial reporting, right? Not just reporting on financials, but also reporting on internal control over financial reporting or compliance, other reporting considerations. Again, we will look into the details later. So this is the whole thing, right? Whether I should accept the engagement, then after accepting the engagement, I do all of this, right from planning to obtaining the evidence, to forming your conclusion, and finally reporting. And you have to keep these in mind overall objectives: documentation, communication, quality control of the firm. And here, if you see quality control at the engagement, that means in this particular engagement also, have I fulfilled the quality control requirements? That means, am I issuing the appropriate report? Have I followed the appropriate standards? Okay. The independent audit function. The purpose of an audit is to provide financial statement users with an opinion. What is the purpose of audit? Is to express an opinion. On what? On whether the financial statements are presented fairly, in all material respects, in accordance with the applicable financial reporting framework. That means the applicable financial reporting framework. So if you are auditing financials that have been prepared under US GAAP, then you are saying, are the financials presented fairly in accordance with US GAAP? If you are auditing financials which are prepared as per IFRS, then you are saying, are the financial statements presented fairly in accordance with IFRS? If you are auditing financials which are prepared under some other OCBOA, other comprehensive basis of accounting, that means cash basis of accounting, regulatory basis of accounting, income tax basis of accounting, contractual basis of accounting, right? Some other comprehensive basis of accounting, which are called special purpose frameworks. Special purpose frameworks. Then we are saying, are the financials presented fairly in accordance with that framework, whatever that framework is? So the question is, we cannot say as a blanket statement that financials are presented fairly. Financial statements are presented fairly. We cannot end the sentence here because it would have no meaning. Financial statements are presented fairly as per what? Okay. Is it presented fairly as per GAAP? Is it presented fairly as per IFRS? Is it presented fairly as per cash basis of accounting? Unless and until you tell that to the reader will not be able to make any sense out of this statement. So this last part is extremely important. You are expressing an opinion on whether the financial statements are presented fairly in accordance with. Okay. And also in all material respects. In all material respects. That means material, again, in simple English, simple layman language. Okay. Material means anything. And of course, we will see that this language, we will also see a similar language in audit, that anything that can influence the decisions of the users, that can influence the decisions of the users is material. Right? Now, in a multi-million dollar company, suppose this is the balance sheet and they have assets of $10 million. And some item is misstated by $10, just $10. It should have been, let's say 50,010, but they are reporting it at 50,000. There is a misstatement of $10. Will it make any difference? It's a $10 million asset base. In that, a $10 difference, will it make any difference to anybody? Right? No. So it's immaterial. We are not talking about immaterial things. We are talking about something that can influence the decision of the user. Those are material. So it is fairly stated. The financials are presented fairly in all material respects. Immaterial things can be ignored. Immaterial things can be ignored because it is not influencing the decision of the user in any way, in any which manner, right? So immaterial things can be ignored. But material things cannot be ignored. It must be fairly presented in all material respects. Okay. Now, what is material? How much is material in a $10 million balance sheet? Is $100 material or $1,000 material? Is $10,000 material? What is material? We will look at the concept of materiality later. But right now the point is that if something is immaterial, no problem. You can ignore it. But if something is material, then it has to be, the financials have to be presented fairly in all material respects. Clear? Also, presented fairly. The word presented fairly has a specific meaning. It is not saying financials are presented ethically, financials are presented correctly, financials are presented accurately. It is saying financials are presented fairly. What does it mean? What it means is that financials are faithfully representing what has actually happened. Okay, so there are some qualitative characteristics of financial statements. Qualitative characteristics of financial statements. They are called fundamental qualitative characteristics and enhancing qualitative characteristics. Fundamental qualitative characteristics have two things: relevance. The financials must be relevant and they must be reliable. Reliable means they are faithful representation. They are faithfully representing what has actually happened. So if you have incurred a loss of $1 million, but in your income statement you are showing you have made a profit of $1 million, it is not faithfully representing the actual scenario. Similarly, if you have made a profit of $1 million, but you are showing in the income statement that you have made a profit of $1.5 million, it is not faithfully representing what has actually happened. Right? So it is not a faithful representation. It is not reliable information. So whatever has happened, if you are specifying that, if you are stating that, if you are showing that, then we will say financials are presented fairly. Now, what that means is, I mean, you must be thinking that, isn't that obvious? Does that also not mean that they are presented correctly? But I'll tell you the difference here. Presented fairly, as I said, just means that whatever has happened, you are presenting that. So if you have done something wrong, okay, just as an example, I'm saying, just as an example, we will explore this again later. If the company has done something wrong, and in the financials, they are giving a disclosure that this is something we have done wrong. That means it is faithfully representing what it has actually done. Okay, just example. They have done something wrong and they are mentioning in the financials that they have in the disclosures, in the notes, that we have done this wrong. Suppose, okay, hypothetical example. What is the auditor going to do? Auditor is going to say the financials are presented fairly, because again, they have done something wrong, but still auditor is saying financials are presented fairly. So as I said, this word fairly has a very limited connotation, I mean a very limited application. As long as the client is showing what they have done, we are saying financials are presented fairly. Okay, so keep that in mind. We will explore this later again in detail. Fairly, what has actually happened is being presented, so it is fairly. The applicable financial reporting framework is the financial reporting framework that is acceptable in view of the nature of the entity and the objective of the financial statements, or that is required by law or regulation. Acceptable financial reporting framework include general purpose frameworks designed to meet the needs of wide range of users. For example, US GAAP and IFRS are general purpose frameworks. But acceptable financial reporting framework also include special purpose frameworks. Okay, so acceptable financial reporting framework include both general purpose framework like US GAAP IFRS and special purpose framework like income tax basis of accounting, regulatory basis of accounting, right? Contractual basis of accounting, cash basis of accounting, all that. Also, who are users? Who are the users? So the primary users of the financial statements, primary users are investors, that means shareholders who have invested their money in this company, potential investors who are about to invest their money in the company, lenders who have lent money to the company, like bondholders, debenture holders, banks, financial institutions, and other creditors. Creditors means who have given inventory to you on credit. So their money is also blocked with you. With you means your client, the company that we are auditing. So whosoever's money is involved, investor has invested their money, potential investor is going to invest money, lender has lent money, creditor's money is blocked with us in the form of raw materials, etc. Whosoever's money is involved, they are primary users. Only these are primary users of the financials. Everybody else is a secondary user whose money is not involved, but they are in some other way interested in the financials, like income tax authorities, IRS or IRS, then SEC, Securities Exchange Commission, other regulators, researchers, employees, right? Anybody else, basically, apart from these four categories: investor, potential investor, lender, creditor. Anybody else is a secondary user of the financials. The auditor's report gives credibility to the financial statements. Auditors as a group, independent of management, have an objective view and can report on company's activities without bias or conflict of interest. Without a report from an independent auditor, company's financials would be meaningless because public would have little faith in the financials issued by inherently biased company. Right? Company will always be biased, right, towards its own financials. They will always try to show a good picture, even if it is not a good picture. So they are inherently biased. Therefore, an independent party is required, right? And that adds credibility to the financials. That yes, some independent party has gone and done an audit. The financials of an enterprise are prepared by management of the enterprise. Who prepares the financials? The management, prepared by the management, not by the independent auditor. Further, financials are the product and property of the enterprise, right? It is the property of your client, not your property. Independent auditor merely audits and expresses an opinion on them. So independent auditor audits and expresses an opinion on them. Auditor does not prepare the financials. Management prepares the financials. Auditor audits them and expresses an opinion on them. What are the management's responsibilities? Preparation and fair presentation of the financials. So preparing the financials and fairly presenting it is the responsibility of management. DIM of IC, design, implementation and maintenance of internal control. This is called DIM of IC. Is the responsibility of management. That means designing internal controls, implementing them and maintaining them, relevant to the preparation of preparation and fair presentation of the financials that are free of material misstatement due to error or fraud. So it is not, we are not talking about all internal controls of the company here, right? Whether employees reach on time, we are not talking about that. Whether a salesperson is actually visiting a client or is meeting a friend and whiling away his time, we are not talking about that. We are not talking about all internal controls of the company. Whether a person who is saying I'm doing work from home is actually working at that time or is not working, doing some other thing. We are not talking about that. We are talking about those internal controls that are relevant to the preparation and fair presentation of the financial statements. Design, implementation and maintenance of internal controls that are relevant to the preparation and fair presentation of the financial statements. And what financial statements? Financial statements that are free of material misstatement due to error or fraud. That is the responsibility of the management. right? And providing the auditor with access to information and persons within the entity needed to complete the audit, right? So auditor can have access to all the information, to the systems, and also have access to people, go and talk to the production staff, then go and talk to the marketing people. They can go and talk to to people in different department. They must have access to those people, to the general counsel's office, legal department, right? Compliance department, all that. Auditor must have access to all that. So management has to ensure that auditor gets access to all that. Management's responsibility. Okay. So pass key, preparation and fair presentation of financial requires. What does preparation and fair presentation mean? That you are identifying the correct framework for you, which framework is applicable to you. So management has to determine that which framework is applicable to them. Second, that it is being prepared and fairly presented, right, in accordance with the framework. And third, description of the framework. Inclusion of an adequate description of the framework. That means the notes must describe which framework has been used in these financial statements, right? Or under which framework these financials have been prepared. So all this is the responsibility of management, identifying the framework, preparing and fairly presenting the financials as per that framework, and describing that framework in the financials. Then demo of IC, and then providing auditor with access to information and persons. Okay, clear? What are the auditor's responsibilities? Auditor is responsible for expressing an opinion on the financials based on the audit. Based on the audit. That means auditor cannot express an opinion without performing the audit. That it is my friend's company, it is my friend's father's company, it is my father's company. Let me issue the report. No, not allowed. You cannot express an opinion without performing an audit. So you have to express an opinion based on your audit. You have to actually conduct the audit and then express your opinion. Auditor is also responsible for maintaining professional skepticism. Maintaining professional skepticism. What does it mean? We will see here. Number 2, complying with relevant ethical requirements. Number 3, exercising professional judgment throughout planning and performance of the audit. Right? Throughout planning and performance of the audit. So in your professional judgment page, you can also write this. Where is professional judgment required? Throughout planning and performance. Just as a pointer, write it. Throughout planning and performance of the audit. And reference is A1 M2 page 9. A1 M2 page 9. Fourth, obtaining sufficient appropriate audit evidence. These words are always prefixed with audit evidence. Sufficient evidence has to be sufficient and it has to be appropriate. Sufficient appropriate audit evidence, and finally complying with GAS, the generally accepted auditing standards. And which means that if you are doing an audit of an issuer, then we are talking about PCAOB auditing standards. If you are doing the audit of a non-issuer, then we are talking about SAS. So GAS is a more broader term. Complying with GAS. So auditor's responsibility is to express an opinion based on the audit, and auditor is responsible for maintaining professional skepticism, complying with ethical requirements, exercising professional judgment, obtaining sufficient appropriate audit evidence, and complying with GAS. Right? 5 responsibilities. I mean, also, 5 responsibilities in addition to the main responsibility is expressing an opinion. Professional skepticism. Auditors should plan and perform the audit with professional skepticism. Professional skepticism is an attitude that auditor must apply when making professional judgments that provide the basis for auditor's actions. Professional skepticism is necessary to the critical assessment of audit evidence. That means, in simple words, what is professional skepticism? In simple words, don't accept the client on face value. That means basically trust but verify. So if the client is giving you some explanation, okay, fine, trust, but verify that. Don't trust blindly. Don't take it on face value that, okay, the managing director has said this, so it must be true. Or this person is so senior in the industry, he must be having high integrity. He must be a person with high ethical standards. If he's saying this, it must be correct. No. As an auditor, you cannot trust anybody blindly. As an auditor, I know it may sound very this thing, but as an auditor, that's your job. You cannot trust blindly. You can trust, but you have to verify. Trust but verify. Okay. So basically, be alert for audit evidence that contradicts other audit evidence. Mr. A said this, production team said this, but finance department is Mr. B, finance department is saying something else. Right? Mr. B said that electricity expense of June increased because production was high during the month of June. We used more power. You went and checked the production records. June was also same as May. Then why did the electricity expense increase in June? Right? So don't take anything or anybody at face value. Oh, okay, electricity expense increased because production increased. Okay, fine. No, not fine. Go and check. Check the production records. Did production actually increase? They manufactured 10,000 units in May. They manufactured 15,000 units in June. 10,000 trucks versus 15,000 trucks. Yes. Electricity power went up. Okay. So corroborating evidence. That's called corroborating evidence. That means verify one evidence with another evidence. Audit evidence that, so if some audit evidence is contradicting other audit evidence, you should immediately become alert. Information that calls into question the reliability of documents. Documents are not reliable. Immediately become alert, including the identified controls over the preparation and maintenance of such information and response to inquiries that may be used as audit evidence. Conditions that indicate possible fraud. Circumstances that suggest the need for audit procedures in addition to those required by GAS. That means while doing the audit, you feel that no, I need to do more. The need for additional audit procedures itself is an alarm bell. Why it led to that feeling that I need to check more. I am not happy with what I have seen so far. I need to dig further. The very fact that you are getting that feeling that I need to dig further means that there could be something wrong, right? So obviously you are already alert. That's why you are saying dig further. Let me dig further and see what comes out. But yes, keep that in mind while doing everything else, not just that area. Remember, if you are just doing, suppose, AR and you want to dig further, don't just limit it to AR, because AR is closely linked to revenue, right? Also, another aspect, that if you come across one instance of fraud, never think that this was the only case of fraud and I have dug it. Never think like that. Think the opposite, that I have dug one fraud. That means there could be multiple other frauds which I have not been able to dig yet. Okay? So don't give a pat on your back that there was only one fraud in this company which I have found out. I'm a great auditor. No, don't give up. Of course, give a pat on your back that at least you have found one fraud. But it's not the time to take rest. It's the time to do more work. That means there could be other frauds in this company which I need to find out. Okay, that is professional skepticism. Audit evidence that may impact the auditor's consideration of the initial identification and assessment of risk of material misstatement. So you initially identified and assessed risk of material misstatement. Now you have come across some evidence that impacts that decision or that consideration. Now you have to revisit your risk assessment procedures and see, okay, because something has come to my attention, now I need to go back and check that the risk assessment that I did, was that enough or do I need to do something else about it? Okay, so that is professional skepticism, which is one of the 5 points. And right, and in this there are 5 points. Then comes, so this pass key, very important. Auditors should neither assume management is dishonest, neither assume that management is dishonest, nor assume unquestioned honesty, that they are extremely honest. There cannot be any fraud in this company because this management is extremely honest. Don't assume that also. At the same time, don't assume that management is totally dishonest. Don't assume anything. Basically, don't assume anything. Don't assume they are dishonest. Don't assume they are honest. You do your work. You corroborate everything. You do your procedures, each and every procedure. Don't let your guards down. Right? Don't start feeling comfortable with the client that, no, I have done this client for 5 years. Nothing has come up ever. That means there cannot be anything wrong even this year. No, even if you have done this audit for 5 years, there can be a fraud in the 6th year. Right? So please do not assume anything. A belief that management is honest and has integrity does not relieve the auditor of the need to maintain professional skepticism or allow the auditor to be satisfied with less than persuasive evidence. So it does not relieve you of your responsibilities. Does not relieve the auditor of your responsibility. You still have to do it. Right? All the must, required, should, all those requirements, you have to still fulfill it. Impediments to acting with professional skepticism. What can come? Impediments mean what can come in the way of your acting with professional skepticism. You were acting with professional skepticism, now something has come into the way of that. What are those things? Unconscious human bias. As I said, I have been doing this audit for last 5 years. Everything has been good. Nothing has come up ever. That's in my subconscious mind, I'm forming a bias, which is dangerous because that means I'm going to be a little relaxed. Just give me one moment, please. Okay, so auditors should act with professional skepticism throughout the audit. However, auditors often feel challenged to meet this requirement because of impediments to applying professional skepticism during an audit. Examples: unconscious human bias. So there could be an incentive and pressure to maintain and build client relationship. Provide an unmodified opinion, keep audit cost low, or cross-sell other services. right? So you may have some pressure to 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 maintain a good relationship with the client. Either incentive in the sense that maybe it's your dream company, you are doing the audit of Apple or Microsoft. Okay, you are doing the audit of Apple or Microsoft or Tesla, and this is your dream company. You want to work in this company or OpenAI, whatever. Now, you are doing the audit and one day you want to join this company. So obviously you don't want to, you know, you want to have good relationship with the management. You want to be in their good eyes, you know, so that someday you apply to this company and they offer you that job. So you don't want to make them angry. You don't want to, even if something is wrong, you're not highlighting, because by highlighting, they may get little disturbed, right? So unconscious human bias can lead you to not exercise professional skepticism, or there could be other pressure from your own firm that we have to, we have to provide, we have to get more business from them, cross sell other services. That means we have to get more business from this client, so keep them happy, they'll give us more work, right? Or keep the audit cost low. Now obviously if you have to keep the audit cost low, maybe you will have to skip some procedures because procedures cost money, right? Maybe you had to involve an expert, but you did not involve that expert because obviously you would have to pay to that expert, right? You are doing an audit of an oil and gas company and you had to engage an oil and gas expert, but you did not engage that oil and gas expert. So then second point, development of an inappropriate level of trust or confidence in management. This is that point which I mentioned. Inappropriate level of trust in the management. I know these people for so long. Or, as I said, this is my friend's father's company. Or, something like that, where you have developed a level of trust or confidence in them. And therefore, you're not taking a questioning stance, not taking a questioning stance. Then pressure to avoid negative interactions. Pressure to, again, similar point, pressure to avoid potential negative interactions with individuals whom auditors know instead of representing the interest of investors, right? Again, just to please them. Then scheduling and workload demands, which may result in auditor making shortcuts, too much work. So too much work, you are skipping some things. Making shortcuts in judgment, seeking audit evidence that is easier to obtain. You're obtaining evidence which is easier, rather than which is more reliable and relevant. So instead of going for a more reliable and relevant evidence, you're going for one which is easier to obtain. Okay. So you had to do, suppose, 20 samples. 2 samples were wrong. Wrong in the sense there were misstatements in these samples. Misstatements. Okay, let's say vouchers. 2 vouchers. Now you thought, okay, this misstatement, I have to do some work now, extra work. My boss will say, do 20 more. Let me do this. Let me ask the client to replace this with 2 other vouchers which are not misstated. Now, so that's a huge risk, because maybe this was a case of fraud. You could have dug a fraud here, but you just let that go because you wanted to save time. Okay. So that is professional skepticism. I mean, impediments to acting with professional skepticism. Then comes the ethical requirements. Guys, it's 11 o'clock. Do you want to take a break? Let's take a break now. We'll continue with ethical requirements after the break. Yeah. And override of controls, Gurpreet. Override of controls, I gave okay, I'll give you another example. Suppose you have to swipe your card to enter the office, right? You have to swipe your card to enter into the office building, correct? Now, the CFO is approaching, the guard salutes him and opens the gate for him, opens the gate. The CFO does not even swipe the card. Now the system has not recorded that CFO has entered the office, right? So CFO comes anytime. Because he is the CFO senior person, the guard does not even ask him to swipe his card. So the data is not getting recorded at all. When is the CFO entering and exiting the office? That is, so control is there. There is a guard, there is a swiping machine, but it is not being swiped by the top management. That's an override of control. Control is there, but it is not being followed for some people. Okay, clear? Presented fairly. So Paras, presented fairly, we will see, when we do MCQs and all, presented fairly has a very limited sort of, meaning here. Presented fairly means whatever has actually happened, if that is being presented, we are saying the financials are presented fairly. So even if something has been done wrongly, but financials are disclosing that this item has been treated like this wrongly, we will say financials are presented fairly. This is the example I gave. We will still say financials are presented fairly because it has been disclosed. So it has been faithfully represented. What has actually happened has been disclosed. So we will say financials are presented fairly. Okay. Of course, something has been done wrongly and it has not been disclosed, then obviously the financials have not been presented fairly. Clear? So it is slightly counterintuitive that something has been wrong and still we are saying financials are presented fairly, right? So slightly counterintuitive, but that's how it is. Okay, so we will cover this after the break. Let's go for a small break. Around 15 minutes. Ethical requirements. Auditors should comply with ethical requirements related to financial statement audit engagements, including independence in both fact and appearance. That means not only the auditor has to be independent, but also appear to be independent. Ethical requirements include AICPA Code of Professional Conduct and the rules of the state boards of accountancy and the applicable regulatory agencies that are more restrictive, right? So independence requirement is there in the Code of Professional Conduct, also in the rules of the state boards of accountancy and certain other regulatory agencies like Department of so we will see in A6 there are 3 modules in A6 which talk about the ethical requirements, right? The auditor must be independent of an entity when performing an engagement in accordance with GAS, unless GAS provides otherwise, or auditor is required to, by law or regulation, to accept the engagement and report on the financials. That means here it's saying must. Must means unconditional requirement, right? Mandatory. So auditor must be independent. Unless GAS provides otherwise, unless, GAS allows in certain circumstances, or the law or regulation in certain circumstances may allow allow the CPA to do the audit even if the CPA is not independent, right? But those are exceptional cases, absolutely exceptional cases. The general rule is that auditor must be independent. Professional judgment. Auditor should exercise professional judgment in planning and performing an audit. Professional judgment is necessary because an audit requires interpretation of ethical requirements and gas, as well as informed decisions based on application of knowledge and experience, right? So remember one thing, it is not judgment, it is professional judgment. That means the judgment is not just, again, it is not based on your whims and fancies. It is a well-informed judgment, informed decisions based on knowledge and experience. It is not about your feeling or your mood, right? It is a well-informed decision, judgment based on informed decisions and which is based on application of knowledge and experience. That means if a person with similar knowledge and experience had to take that judgment, most likely that person would have also reached the same judgment that you have reached. With your knowledge and experience, and the person has similar knowledge and experience, would have reached the same judgment, most likely. Okay, it is not about bias. Judgment here does not mean that you can use your bias or, you know, or it becomes subjective. Of course, judgment by itself is slightly subjective, but even in that, it has to be as objective as possible. Okay. As objective as possible. In an audit, professional judgment is necessary when making decisions about materiality. So this is a ready-made list given here, right? So please put it in your professional judgment page. Materiality, audit risk, nature, extent, and timing of audit procedures, whether sufficient appropriate evidence has been obtained. That's also a matter of judgment, that the evidence we have obtained is sufficient or not, or do we need more? Is it appropriate or not? Then evaluating management's judgments in applying the applicable financial reporting framework. That is US GAAP the correct framework for them? Right? Evaluating that judgment of management. It's a responsibility of management to decide the framework. But as an auditor, you have to evaluate the management's judgment. And you have to use, basically, you have to use your judgment in evaluating their judgment. And again, your judgment will be based on knowledge and experience. For example, if you're listed with the Securities and Exchange Commission, you can file financials with the SEC, which are prepared under US GAAP. So if you are registered with SEC and you have prepared financials in US GAAP, then you have chosen the right framework. But SEC also allows you to file financials under IFRS. So if you have chosen IFRS as your framework, then also you have chosen the right framework. No problem. If you have chosen some other framework, you are an Indian company registered with SEC. So you have prepared your financials based on Ind AS. Is it the right framework? Yes, it is the right framework because SEC allows you to file under foreign GAAP also. But if you are preparing under a foreign framework, I mean, for US, Ind AS is a foreign framework. So if you are preparing under a other country framework, then you also have to give reconciliation between US GAAP and that other country framework. That net income as per Ind AS is this. What are the things that you have add less? This is the net income as per US GAAP. So you have to give a reconciliation between the two if you are providing the financials under some other gap. So whether the management has prepared the financials based on that framework, and if they have followed some other framework, have they given the reconciliation? So that is something, again, it is a judgment, but it is based on knowledge and experience. And finally, drawing conclusion based on the audit. Your opinion itself is a judgment, right? So drawing conclusion based on the audit evidence obtained is itself a judgment, right? Should I give unmodified opinion to them? Should I give a qualified opinion? What kind of opinion should I render? Right? So determining the materiality, is 10,000 material or 15,000 is material or 50,000 is material. How much is material? Matter of judgment. Audit risk, nature, extent and timing of the audit procedures. Which audit procedures should I perform? When should I perform them? Timing. How much should I perform them? Extent. And which audit procedure should I perform is the nature. The evidence that I have obtained, is it sufficient or do I need more? Is it appropriate or do I need to do some other audit procedures or obtain other evidence? Right. So all this is matter of judgment based on knowledge and experience. Then comes sufficient appropriate audit evidence and audit risk. To obtain reasonable assurance, remember, with the word assurance, the word reasonable is prefixed. With the word audit evidence, the two words sufficient and appropriate are prefixed. Right? So to obtain reasonable assurance, auditors should obtain sufficient appropriate audit evidence to reduce audit risk to an acceptably low level. Remember, audit risk can never be zero. Audit risk can be reduced to an acceptably low level. That yes, now it is low, I can accept this much risk. There is always a risk, but the risk has to be very low so that I am able to accept that risk. Right? Right? Every time we go out on the streets, there is always a risk of an accident, but the risk is low. So I go out of home and I drive my car, I walk on the footpath, whatever. I don't sit at home because there is risk. But the risk is low enough for me to accept that risk, that I can take that risk of going out of home. Similarly, I have to reduce my audit risk to an acceptably low level. There is risk, but once it is acceptably low, I can go ahead and do the audit. Right? I'm willing to take that much risk, that yes. So audit risk has to be reduced to an acceptably low level and thereby enable the auditor to draw reasonable conclusions on which to base the auditor's opinion. Okay. Enable the auditor to draw reasonable conclusions on which to base the auditor's opinion. And by the way, why can't audit risk be zero? Because remember, audit risk is IR into CR into DR. So there is always an inherent risk. There is always an inherent risk. There is always some control risk. There is always some detection risk. So it can never be zero. None of these are zero because it's a multiplication. If any of these could be zero, then audit risk could become zero. But unfortunately, none of this can be zero. Even if it is very, very low, 0 point something, but there will be some number. It can't be zero totally. Okay, so that is why audit risk cannot be totally zero. But it can definitely be reduced to an acceptably low level. Compliance with gas. Auditor should not represent compliance with gas in the auditor's report unless the auditor has complied with all gas relevant to the audit. That means auditor cannot say in the report we have complied with gas until and unless the auditor has actually complied with all gas, all. If you have complied with all gas requirements, only then can you say we have complied with gas. If you have not complied, then you can't say we have complied with gas. Okay. If the objective of a relevant gas section cannot be achieved, auditor should consider whether this prevents the auditor from achieving the overall objective of the auditor, and thereby requires the auditor in accordance with gas to modify the auditor's opinion or withdraw from the engagement. Right? So if the objective cannot be achieved, then modify the opinion. Don't say we have complied with gas. Modify the opinion or withdraw from the engagement. So you can understand how important it is to comply with gas. That if you are not able to comply with gas, you will either modify the opinion or withdraw from the engagement. So make another A4 sheet, withdraw from the engagement. In which cases will the auditor withdraw from the engagement? And this is the first point, right? Not being able to comply with gas. If the objective cannot be achieved. Okay. Not complying with gas, objective cannot be achieved. Page reference A1 module 2 page 10. And I need all of you to make these pages, please. It's going to save tremendous amount of time before the exam. Otherwise, audit is one subject where you can get lost in the syllabus. In certain audit engagements, the auditor may be required to comply with other auditing requirements in addition to gas. Gas do not override laws or regulations that govern an audit. So auditor may conduct the audit in accordance with both gas and PCAOB, gas and ERISA. ERISA is Employee Retirement Income Security Act. Gas and ISA's International Standards on Auditing, gas and gas and auditing standards of a specific jurisdiction or country. So we will talk about all these aspects in later modules, right? For example, we just saw that if there is an entity that receives federal financial assistance, federal financial assistance will be subject to the audit under GAGAS. But it's a private sector organization, but it receives federal financial assistance. Now, because it's a private sector organization, we will do the audit under gas. But because it receives federal financial assistance, we will also do the audit under gas. So we will now do this audit based on gas and gas. That's why it is and. You will not do the audit just under gas. You will do the audit under gas and gas. That's why here it says in addition to gas. You may be required to follow other things in addition to gas. Okay. Reasonable assurance and inherent limitations to an audit. So guys, what are the words used for evidence? Yes, quickly in the chat box. What are the words used for evidence? Page number reference for that one. It was A110. A1 module 2 page 10. Right. So the two words used for evidence is sufficient and appropriate. Sufficient, appropriate audit evidence. Sufficient, appropriate audit evidence. What are the words used for assurance? Word or word? Just one word. Reasonable. Reasonable assurance. So we will see why it is reasonable, why not absolute assurance. Why not absolute assurance? Only reasonable assurance. Okay, we don't need an absolute assurance. We need reasonable assurance. So why? Because there are some inherent limitations to an audit or of an audit. That's why absolute assurance is not required. Reasonable assurance is required because we are working under certain constraints. In order to express an opinion, auditor obtains reasonable assurance about what? About whether the financials are free from material misstatement. Financials are presented fairly. That means they are free from material misstatement. Immaterial can be there. Immaterial we will not bother about. But they are free from material misstatement. That means there is no material misstatement in the financials. We have to have a reasonable assurance about that. A reasonable assurance about whether the financials are free from material misstatement, whether that misstatement is due to error or fraud or anything else. This whether part, this whether due to error or fraud or anything else also doesn't matter. Question is, it should be free from material misstatement. We are reasonably assured that the financials are free from material misstatement. Right? Reasonable assurance is a high assurance. High. It's not low. It is high, but it is not absolute level of assurance. In order to obtain reasonable assurance, auditor must plan the work and properly supervise the assistants, determine and apply appropriate materiality levels, identify and assess risk of material misstatement, whether due to fraud or error, and obtain sufficient appropriate audit evidence. Right? Now, what is the difference between fraud and error? Error is unintentional. Error is unintentional. And fraud is intentional. Correct? So fraud is much more dangerous because it is intentional, but the likelihood of digging a fraud or catching a fraud is low because it is intentional. The person committing the fraud will always try to conceal the fraud. Nobody will leave the fraud open for auditors to come and check to detect that, see, I have committed a fraud, come and see. No, whoever has done a fraud will try everything possible to conceal it, to conceal the fraud. And that is why it becomes even more difficult to detect it. Errors might be easily detected because the person himself or herself did not know that they are committing. It was unintentional. So naturally, there is no attempt to even conceal it because the person does not even probably know that they have committed an error. So it's open. It's not concealed. It's not hidden. But intentional fraud is always hidden. Always hidden. Right? So therefore, it becomes even more difficult to detect a fraud than an error. So identify the risks, assess the risks, obtain sufficient appropriate audit evidence, apply appropriate materiality levels, of course, plan the work properly, supervise the assistants properly. Auditor is unable to obtain absolute assurance that financials are free from material misstatement because of the inherent limitations. Number one, nature of financial reporting. Some financial statement items are subject to inherent level of variability because they involve judgment by management or because they involve subjective decisions or assessments or degree of uncertainty. For example, estimates. Right? What will be the credit loss? How much percentage should be booked? Excuse me. Excuse me, sorry. How much percentage should be booked as an allowance for credit loss? What is the life of fixed assets? Then in fair value, we have seen, in FAR, we have seen in fair value, there are three approaches: the market approach, income approach, cost approach. There are different levels of hierarchy: level 1, level 2, level 3. If level 1 is not available, then the management has to go for level 2, level 3. If level 2 is not available, they have to go with level 3. Level 3 involves a lot of assumptions, right? Income approach, fair value. How do you calculate fair value under income approach? It is the present value of future cash flows. Future cash flows, how much will be the future cash flow in itself is an estimate. This estimate, obviously the word estimate itself means that it is not precision, it is not precise, it lacks precision. So obviously something which is not precise, there is judgment involved, assumptions involved. And those assumptions and judgments could go wrong. Right? Warranty. How many cars will come for repair? You have sold 100,000 cars during the year with 3-year warranty. How many cars will come to you for repair? Right? Estimate. So multiple places there are estimates involved in the financials. Judgment by management. Subjective decisions. Degree of uncertainty. So the financial reporting itself is, such that there is inherent level of variability. Secondly, nature of audit procedures. There are some limits, legal limits. It's not an investigation. It's an audit. You can't do certain things which an investigator can do. So there are some practical limits, there are some legal limits on auditors' ability to obtain audit evidence. Possibility that management or others may not provide, intentionally or unintentionally, complete information that is needed for the preparation and presentation of financials or as requested by the auditor. Management may not provide all the information. Fraud may be concealed. Fraud is never left open. It's always hidden. Makes it difficult to detect with normal audit procedures. An audit is neither an investigation into a wrongdoing, nor does the auditor have specific legal powers to do an investigation. So there are inherent limitations in an audit. That's why we cannot obtain absolute assurance. Unable to obtain absolute assurance that financials have no material misstatement. We can only obtain reasonable assurance that financials do not have material misstatement. Then third point, timeliness, cost and benefit. Timeliness. There is an expectation by users of financials that auditor will form an opinion on the financials within a reasonable period of time and will achieve a balance between benefit and cost. Recognizing that it is impracticable to address all the information that may exist. Right? Benefit and cost. If my audit fee is $10,000 and I have to perform an audit procedure that will cost me $12,000, okay, I have to hire a chopper, a helicopter to go into the ocean to, this is an example, not very apt example, because if you have to visit the oil rig, of course, client will make arrangements for it. But let's take some other example that you have to determine how much oil is there in that well. So you need an expert. You have to hire some consulting firm like maybe A.T. Kearney or Accenture or, companies like that, consulting firms, or experts, oil and gas experts, right? Maybe if I talk about India, let's say somebody like ONGC, and money is involved. Obviously, you have to engage somebody, so you have to pay. So money is involved. And suppose that money is huge. So now you're saying, no, I'm not going to perform this procedure because it's more than my audit fee. I'm not going to do this assignment at a loss. Right? I'm just giving an example. Right? So there are some cost benefit considerations. Then, of course, you have to issue the audit report in time, right? A huge company, which with like multi-million-dollar company, you have to finish the audit in 15 days or 20 days, right? It's a multi-million-dollar company with complex transactions, multiple geographies, multiple software systems. They are using Rain Dance, they are using Hyperion, they are using Oracle, right? They are using multiple systems. All of that, multiple geographies, they are in Europe, Middle East, and Africa. Europe, Middle East, Africa, Japan, Australasia, Pacific, Asia. They are in Latin American countries, right? Huge organization, and you have to finish the audit in, let's say, even 1 month is very less time for such an audit, right? But you have to finish it, issue your report. So there are limitations. You are under pressure. Therefore, it is necessary for auditor to plan the audit so it is performed effectively, direct the efforts to areas most expected to contain risk. Direct your efforts to areas most expected to contain risk. Of course, risk of what? Material misstatement. Use testing. That's why we do sampling. Use testing and other means of examining populations. You can't test entire populations. Of course, now with softwares, even testing entire populations have become possible. But traditionally, examining entire populations was not possible, right? So you have to do these things to overcome these impediments, or I mean, even to get reasonable assurance, you have to do these things, right? Okay, so that was your point number 2. Now coming to point number 3, determining the nature and scope of the engagement. Following should be considered as the auditor, the audit committee, and management determine the appropriate nature and scope of the engagement. Auditor may be hired to perform audit of a single period or multiple periods. Audit may be on complete set, complete financials, or a single financial, or specific elements, accounts, or items in a financial. That means you can be asked to do an audit of 2025 and 2024. So it becomes a multiple period assignment. If you're asked to do audit of only 2025, then it's a single period. You may be asked to do the audit of the complete set. Complete set means balance sheet, income statement, statement of comprehensive income, statement of cash flow, and statement of changes in owner's equity. Statement of changes in equity, owner's equity. So this is called the complete set. Plus notes are always an integral part of the financials, always. So this is the complete set. You have been asked to do the audit of complete set, or you may be asked to do for a single financial statement. Just come and do the audit of income statement, or audit of specific element, account, or just do an audit of AR, accounts receivable, right? So all that is possible. All that is possible. Many audit firms are hired to perform tax services in addition to audit services. So the question is, can auditor do tax services for the same client, for the same company? Answer is yes. tax services are allowed in addition to audit services. But we will see the details later again, right? We will see the details later again, but yes, generally tax services are allowed by the same firm. So if PwC is doing the audit of a particular company, they can also provide tax services to that same company. If KPMG is doing the audit, they can provide, right? So same firm can provide audit as well as tax services. Non-issuers, when auditing non-issuers, auditor must determine if the audit is most appropriate engagement or whether a review, compilation or preparation may be more appropriate. If an audit is needed, non-issuer have the choice of financial statement audit only or an integrated audit. Integrated audit means where two opinions are rendered. One on the fairness of the financials and second on the operating effectiveness of internal controls. And which internal controls? Not all internal controls of the company. Internal controls over financial reporting. ICFR, internal control over financial reporting. Operating effectiveness of ICFR. Are the internal controls operating effectively? So opinion on that. And one opinion on, of course, whether the financials are presented fairly. Fairness of the financials means, are the financial statement presented fairly? So when you are giving these two opinions, it's called an integrated audit. So a non-issuer can engage you to do an integrated audit that give us an opinion on these two things, or they can engage you just to do an audit, which is financial statement audit only, right? Or they can engage you to do a review or a compilation or a preparation engagement. So auditor must determine which assignment is most appropriate for them. Auditor must determine if an audit is the most appropriate engagement or whether a review, compilation or preparation may be more appropriate. For issuers, auditor must perform an integrated audit. So for issuers, there is no choice. It's a must. That means you have to do an integrated, you have to provide two opinions. One on the audit of financials, on the fairness of the financials, and one on the operating effectiveness of ICFR. What are the overall objectives of an audit engagement? To report on the financial statements. Correct? To report on the financial statements, whether the financials are presented fairly in all material respects in accordance with the applicable financial reporting framework. So to report on the financial statements and communicate as required by GAS based on auditor's findings. Based on auditor's findings. Without findings, you cannot issue a report. So based on your findings, what was your opinion? You are writing that in your report and communicating it as required by GAS. And to form an opinion, you need to obtain reasonable assurance about whether the financials as a whole are free from material misstatement, right? So to report, you have to first form an opinion. To form an opinion, you have to obtain evidence. You have to obtain reasonable assurance about whether financials are free from material misstatement, whether due to error or fraud, which enables the auditor to express the opinion on whether the financials are presented fairly in all material respects in accordance with the applicable financial reporting framework. Right? So what are the objectives? To obtain reasonable assurance and to report on the financial statements. And of course, communicate. Communicate here basically means you can't, you will not make the report and keep it with yourself. Right? Obviously, then what's the purpose of the report? You will not make the report and keep it in your office, in your drawer. You will issue it. You will communicate it, right? Obviously, it's an obvious thing that you will actually issue it and communicate, circulate it. So you will give it to the client and they will circulate it along with the financials. Objective of audit of internal control over financial reporting. Issuers are required to have an integrated audit of financials and ICFR. In some cases, non-issuers and governmental entities may also have an audit of ICFR. The overall objective of the auditor when conducting an audit of internal control over financial reporting are express an opinion on the effectiveness of the company's internal control over financial reporting and plan and perform the audit to obtain appropriate evidence that is sufficient to obtain reasonable assurance about whether material weaknesses exist as of the date specified in the management's assessment. So here, reasonable assurance is about what? About whether material weaknesses exist. Okay. So there are certain, when we are talking about internal controls, we talk about deficiencies in internal control. Are there any deficiencies in internal control? So those deficiencies are further categorized into 2 or 3. There is a classification. The highest classification is material weakness. There is a material weakness in internal controls. This is the worst weakness, material weakness. So other weaknesses are okay. I mean, we are okay to live with those weaknesses, but material weakness, we are not okay. So that is why we are obtaining reasonable assurance about whether material weakness exists. Okay. So basically, I'll quickly tell you, the deficiencies are classified into material weakness, significant deficiency, and other deficiencies. So this is the least. This is fine. I mean, we are not bothered too much about other. Significant deficiency should not be there, and material weakness definitely should not be there. So if there is a material weakness in the controls, then we have to report it. And if there is a significant deficiency, then what do? We will discuss that when we go to internal controls, when we go to the specific topic of ICFR. Right now, it is just telling you that what are the objective of an audit of ICFR. Okay. So material weakness is the key word here. Audit of internal control over financial reporting must be integrated with audit of financial statements. It must be integrated. What does that mean? That's why it's called an integrated audit. So what that means is that the same CPA or CPA firm must do it. Must be integrated with the audit of financials. It cannot happen that firm A is doing the audit of financials and firm B is doing the audit of ICFR. That is not an integrated audit. Those are two separate audits. But integrated audit means the same firm, if A is doing the audit, A will only do the ICFR, audit of ICFR. If B is doing the audit, B will only do the audit of ICFR. Two separate firms will not be involved, or two separate CPAs will not be involved. Okay. Objectives of ERISA. So what is ERISA? We just saw here. Where did that go? Yeah, this one. Employee Retirement Income Security Act, okay, of 1974. Retirement income, employees' retirement income security, that it is secure. Okay, because that's a huge issue. Retirement income is secure or not secure is a huge issue. Okay. So there's an act on that of 1974 ERISA. Overall objective of auditor when conducting an ERISA plan financial statement audit are accept an ERISA plan audit engagement when the basis upon which it is to be performed has been agreed upon through establishing whether the preconditions for audit are present. That means the preconditions, there are certain preconditions for doing this audit. Are those preconditions present? That means have they been met? Only then can you accept this engagement, otherwise not. Appropriately plan and perform the audit of ERISA plan financials, including procedures required by this SAS on the certified investment information when management elects an ERISA section 103A3C audit. Right? So basically appropriately plan and perform the audit. And if it is a 103A3C audit, then a particular SAS will become applicable. So what are the procedures required by that SAS? Then third, form an opinion on the ERISA plan financials based on evaluation of audit evidence obtained, including evidence obtained about comparative financial statements. That means you have to do this also. Evidence obtained about comparative financials. So it becomes a condition, a requirement. Right? Fourth, express clearly the opinion on ERISA plan financial statements through a written report. So express your opinion in writing. Number 5, perform procedures and report on the presentation of the supplementary information in accordance with this SAS. Right? And remember, I told you that the SAS numbers are not mentioned in your syllabus. Right? Except for very few, like 1 or 2, not much. So perform procedures and report on the presentation of the supplementary information in accordance with this SAS. Appropriately communicate to management and those charged with governance reportable findings that the auditor has identified during the audit of ERISA plan financial statements. Now make a separate page on communications with management and TCWG. Communications with management and TCWG. See, you have to make separate pages, one on communication with management, one on communication with management and TCWG. So there are certain things that you need to communicate only to management. You don't need to communicate those things to TCWG. Those will go into in the communications to management page. But there are certain things which you have to communicate to both management and TCWG. For that, you make a separate page. This is that page right now, communication to management and TCWG. And right there, reportable findings that auditor has identified during audit of ERISA plan financial statements. Reportable findings that auditor has identified during audit of ERISA plan FS financial statement. During audit of ERISA plan FS, ERISA plan financial statements, page reference, it's A1, module 2, page 13. You can simply write A1 13 also, but yeah, A1 module 2, page 13. I hope you are making these sheets side by side. Don't think that I will make it later. It will never happen. I'm telling you from experience of many students. Let me now focus on the class and I will make the notes later. Trust me, it will never happen. Or if it happens also, it will take you double, triple the time. You'll have to go through it again to see which line it was there. Okay, so please do it along the classes. So only 10 minutes left. So we can't go through module 3. but we can at least get started. In 10 minutes also, we will be able to finish at least maybe 1 or 2 pages, right? So module 2 was big. Module 1 was very easy. I mean, very small. But module 2, audit engagements, audit process overview, number 1. Number 2, independent audit function, the basics, management responsibility, auditor's responsibility, within that professional skepticism, impediments to professional skepticism, ethical requirements, professional judgment, sufficient appropriate audit evidence and audit risk, compliance with GAS, reasonable assurance, inherent limitations of an audit. Then number 3, determining the nature and scope of the engagement. Is it a single period audit, multiple period audit, single financial statement, complete finance set of financial statements? Is it for an issuer or a non-issuer? Is it an integrated audit? Of course, for issuer, it has to be an integrated audit because it's mandatory. For a non-issuer, it may be integrated audit. If the client engages you for an integrated audit, it can be audit of just financial statements, or it could be just a review, compilation, preparation, not even an audit. What are the overall objectives of audit engagements? In financial statement audit, what is the objective? In ICFR, what is the objective? In ERISA, what is the objective? Right? Lots of things. Take your time to revise. Don't rush. You know, it has to get into your, I mean, I know it may sound a little, I don't know, filmy or cheesy, but audit is something that has to get into your DNA. It's not filmy, cheesy. What's the right word? I mean, dramatized, maybe, I don't know. But yeah, audit has to get into your DNA. I mean, that's the bottom line of it. Audit is not just a subject, it's a profession. People make a career in it, right? So it is an actual work that you do, go out and do. I'm not saying you don't do things that you learn in FAR and reg and all that. Of course you do. You file income tax returns based on your reg knowledge. I'm not undermining those subjects, but of course, audit is a very, very heavy subject, extremely heavy subject. You can, I'm sure you have got a flavor from just first 2 modules that each line is so important, each word is so important, right? And next week there is no class, but next time when we meet, we will also do questions and you will further see how they can make a question just from a word. They can just pick up a word and make a question out of it, right? Okay, forming an audit opinion on the financials. Auditor should form an opinion on whether the financials, form an opinion on what? On whether the financials are presented fairly in all material respects in accordance with the applicable financial reporting framework. In order to form that opinion, auditor should take into account the following 3 things. Whether sufficient appropriate evidence has been obtained as required by GAS, whether uncorrected misstatements are material. Uncorrected misstatements are material individually or in the aggregate. So there are 100 misstatements of $5,000 each, suppose. So individually they are not material, just $5,000 misstatement. But because there are so many of them, now this becomes a material amount, right? So it is not just a misstatement in isolation. It is a misstatement in aggregation that you have to see individually or in aggregate, whether it is misstatement or whether it is material or not, and whether the financials are prepared in all material respects in accordance with the required applicable framework, that is GAAP. So to form an opinion, you have to take into account whether evidence is okay, sufficient and appropriate, whether the misstatements are material, the uncorrected misstatements are material or not. And of course, whether financials are prepared in all material respects in accordance with the framework. Have the financials been prepared in accordance with the framework? Prepared in accordance with, let's say, GAAP, right? If all these things have happened, financials are prepared in accordance with GAAP, the uncorrected misstatements are not material, and you have obtained sufficient appropriate audit evidence, then you can say, yes, financials are presented fairly. Financial statements generally mean a complete set, right? Though the applicable financial reporting framework determines the form and content of the complete set. For example, under US GAAP, a complete set is a balance sheet, statement of income or comprehensive income, statement of changes in equity, cash flow statement, and notes, disclosures. When forming opinion, sorry about the background noise, there's some event happening, I think. When forming the opinion, the auditor should evaluate whether, based on applicable financial reporting framework. Now, these are 8 points, important points. And I think this is the last thing we can cover today. So 1, 2, 3, 4, 5, 6, 7, 8. When forming an opinion, auditor should evaluate number 1, financials adequately disclose the significant accounting policies selected and applied, including a description of the applicable framework. That means which accounting policies the company has selected and applied, that needs to be disclosed, adequately disclosed. And also which reporting framework they are using needs to be adequately disclosed. Number 2, the accounting policies selected and applied are consistent with the applicable framework. Right? For example, if LIFO in inventory is not allowed and they are under that framework, they are following a particular framework, under that framework, LIFO is not allowed as a method, then there is something wrong. It's not talking to each other. They're not matching each other. Right? So accounting policies selected and applied are consistent with the framework. And are appropriate. Number 3, accounting estimates and related disclosures made by management are reasonable. Estimates are reasonable. That means, how do you know estimates are reasonable or not? You will go into the past data. If for the last 5 years they estimated this and the actual was this, they estimated 10%, actual was 10%. They estimated 12, actual was also close to 12, 11.5. Then they estimated again 12 next year, it was 12.5. They estimated 14 next year, it was 14. That means their estimates are reasonable. The actual, eventually when the actuals happen, they are very close to the estimates that they had made. That means their estimate making mechanism is working fine. How do they, make their estimates? That mechanism is working fine. So if this year they are saying it's going to be 15, you can say that must be reasonable, right? But of course you will have to see whether it's, you will also have to do your own thing. You can't just rely on the past data. You will also have to do your own and then match it. You will have to develop your own estimate. Auditor will have to develop their own estimate and then compare it with the client's estimate. So you of course have to do it. But this is a very good indication that it must be correct. It's an indication. I'm not saying you blindly rely, but this is a very good indication that in the last 5 years, whatever estimates they had made, the actuals came very close to that. That means their estimate making mechanism is very good. The information that they obtain is very, very reliable, based on which they make the estimate, right? That must be very reliable. Okay, then number 4, information presented in the financial is relevant, reliable, comparable, understandable. Remember, I told you about the qualitative characteristics of financials. Fundamental qualitative characteristics, enhancing qualitative characteristics. Fundamental has relevance and reliability. Enhancing has 4. Relevance and reliability are fundamental. And enhancing has 4. Timeliness, understandable, comparable, and verifiable. That financials are timely, they are being issued timely, they are understandable, they are comparable. Comparable is in 2 sense. One is intra-firm comparison, and other is inter-firm comparison. Intra-firm means within the firm. That means you are comparing your own financials of 2025 with your own financials of 2024. Intra-firm comparison. Inter-firm obviously means you are comparing your financials with another company's financials, typically of the same industry. So Adidas will compare its financials with Nike, Reebok, etc. Obviously, Adidas will not compare its financials with Tesla, right? Tesla will compare its financials with maybe Toyota, Honda, General Motors, etc. Right? Kia. And verifiability means financials must be capable of being verified. That means there have to be supporting documents. Okay, so that is number 4. Number 5, financials provide adequate disclosures to enable the users to understand the effect of material transactions and events on the information conveyed in the financials. So there have to be proper disclosures, adequate disclosures. Adequate is the word for disclosures. Sometimes they ask you a question on that also. Which word goes with what? Reasonable goes with assurance. Adequate goes with disclosures. Like that. Number 6, terminology used in the financials, including title of each financial statement, is appropriate. The title is appropriate. For example, it is not called P&L in the US. It's called income statement in the US. It is called accounts receivables in the US, not sundry debtors. So the terminology has to be appropriate based on the framework. Number 7, overall structure and content of the financial is fairly presented. Overall structure and the content is fairly presented. And number 8, financials including disclosures represent the underlying transactions, which is called faithful representation. It is faithfully representing what has actually happened in a manner that achieves fair presentation. Right? So these are the 8 things that the auditor needs to see when forming an opinion. Auditor should evaluate whether, based on the applicable framework, these things have happened or not. Is there adequate disclosure about policies, about the framework? Are the policies consistent with the framework? Are the estimates reasonable? Are the financials relevant, reliable, comparable, and understandable? The information presented in the financials. Are there adequate disclosures? Like in general, are there adequate disclosures to understand the effect of the material transactions? Terminology is appropriate. Overall structure and content is fairly presented. Financial statements overall, including disclosures, represent the underlying transactions and achieves fair presentation. Right? Okay. Let's just finish this before we end the class, passkey. Then we can start from point number 2 in the next one. The auditor refers to GAS for guidelines on how to perform the audit. The auditor refers to Financial Reporting Framework (GAAP) to evaluate whether the transactions are recorded and reported fairly in the financials. So auditor refers to both GAAP and GAS. And that's why I keep saying that before sitting for the audit exam, you have to have the basic knowledge of GAAP, of FAR, right? Auditor refers to GAS on how to perform the audit. Auditor refers to GAAP to evaluate whether the financials are recorded and reported fairly. The transactions are recorded and reported fairly in the financials. For example, land should not be depreciated. Under US GAAP, land is not a depreciable asset, so it should not be depreciated. For that, you need to have GAAP knowledge. You need to know, is land depreciated or not under US GAAP. This is a very simple example. There are other complex issues, right? For example, there is no concept of revaluation in US GAAP. Revaluation surplus or revaluation loss. These are IFRS items, not US GAAP items. So if you see an item called revaluation surplus in a US GAAP financial, there is a problem, right? So anyways, so these are the things, right? Now, next class, tomorrow there's no class, next weekend there is no class. 8th onwards, we are going to be regular. So in the 8th Feb class, we will do MCQs of M1, M2, and then start with, M3, this point number 2 onwards. Right? Revision of today's class. So I think I've done it pretty slow. Do you still need a revision? I mean, I can do it. I have no issue. Gurpreet, can you, for your query, can you please tell me the page number and para number that you are picking this line from? Shanku, you need a revision? I mean, see, okay, I'll quickly go through it. Module 1, we talked about which standard is applicable to which engagement, right? Audit of non-issuer, SAS, audit of issuer, PCAOB, AS, review of interim financial, if annual is audited, SAS, if annual is not audited, then SARS. Also preparation compilation engagements is SARS. And if it is something other than financial information, like a subject matter or an assertion about a subject matter, you're doing an examination review or agreed upon procedure on a subject matter or assertion about a subject matter, then that's an attestation engagement under SSAE. These are engagement specific standards. Then you have some guideline, 2 guidelines, code of professional conduct, which is applicable to all the members of the firm. Of course, we will see later which there are it breaks down into subtopics, which ones are applicable to members in practice, which ones are applicable to all members, which, like that. But yeah, right now it is basically code of professional conduct is applicable to members, and statement of quality control standards is applicable to the firm as a whole. Then we did the audit gas hierarchy, right? The most authoritative is SAS and PCOB AS, then interpretive, then other. Which ones are interpretive, you need to memorize that. Which ones are other, you need to memorize that. That was module 1. Module 2, we looked at the basics first. That financials are presented. I mean, this is the language that you have to get used to now. Audit has a specific language of its own. Like this, opinion on whether the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework. Now you can't jumble up this statement. Of course, this is not an essay type exam, but I'm just saying that you can't jumble up this statement. You have to write it in this order only. Opinion on whether the financials are presented fairly, and then you can't write in accordance with the applicable financial reporting framework, then comma in all material respects. You have to write it in this order only. It's a very, what should I say? It's very, very evolved, right? There is no scope of reinventing the wheel. It's already very evolved. Already lot of research, brainstorming has happened to arrive at this language. Opinion on whether the financials are presented fairly in all material respects in accordance with the applicable financial reporting framework. Okay. And as we go to the reports, we will see how audit language is framed, how it is written. Then we saw management's responsibilities, mainly to preparation and fair presentation of the financials in accordance with the framework and DIM of IC. And of course, mainly to the third one is of course giving access to the auditor. Then we looked at auditor's responsibility is to express an opinion based on the audit and also responsible for these 5 things: professional skepticism, ethical requirement, professional judgment, sufficient appropriate audit evidence, and complying with GAS. Professional skepticism, be alert at all times. Look for corroborative evidence that look for evidence that contradicts other evidence. If some, some information calls into question the reliability of the documents, is there a possible fraud? Is there any need to do additional procedures? And do I have to revisit my initial assessment of risk? Neither assume management is dishonest nor assume unquestioned honesty. So there's a very, commonly used language in audit firms that we do not go to an audit with a preconceived notion. We do not go to an audit with a preconceived notion that management is dishonest or management is not, or management is totally honest. We do not go with a preconceived notion. Similarly, we do not go with a preconceived notion that the financials are are materially misstated or financials cannot be materially misstated in this company. We do not go with a preconceived notion. We do our normal procedures, but if we come across something suspicious, anything suspicious, we extend our procedures. Then we just don't stick to the normal procedures. We extend our procedures to confirm our suspicion, to confirm or dispel our suspicion. That means if there is a doubt in my mind, I will dig deeper to either confirm that yes, my doubt was right, there is actually something wrong happening here, or to dispel my suspicion that okay, I had a doubt, but now I have dug deeper and I have not found anything, so my doubt was not right. But I need to settle that. I can't live with that doubt. I can't issue my report with a doubt in my mind. I have to extend my procedures to confirm my doubt or to dispel my doubt. That no, my doubt was wrong. Nothing is wrong here. But the fact that a doubt arose in my mind, I have to do extended procedures to confirm or dispel my suspicion. I can't leave it just like that. I can't leave a doubt and still issue a report with a doubt in my mind. Okay, that is what it means. So as I said, it's a very serious profession. Very, very serious profession. Then impediments to acting with professional skepticism, unconscious human bias, right? Inappropriate level of trust or confidence in the client, in the management of the company, client company, incentive and pressure, right? Not taking a questioning stance, avoiding potential negative conflict, negative interaction, making shortcuts due to time constraints, obtaining evidence that is easier to obtain These are all impediments to professional skepticism. Independence has to be both fact and appearance. In India, we have a culture of touching the feet of seniors, elderly people, right? So if it is, suppose, your father's friend's company, you have seen your father's friend has been visiting your house since you were a child. Now you have become a CPA, you are doing audits, and your client, your father's friend, is now your client. He has been visiting your house since you were born, since you were a child. So you have this, obviously, to show respect, you touch, every time you meet him, you touch his feet. Now he has become your client. Whenever you go for the audit, you go to his cabin and you touch his feet. Because for you, he's not your client, he's your uncle, he's your father's friend. But independence is being compromised. You are in appearance, you have to be independent in fact. Maybe you are a very, you are a person of very high integrity. You are saying that if I find a material misstatement, I'm going to qualify this report, even if it is my father's friend. I will not look into that relationship when I'm issuing my report. I will be very professional in my approach. If I find a misstatement, I will issue a report which says qualified opinion. Maybe in your mind, you are independent. But the fact that you are touching his feet every morning, you are going for the audit, you go and meet him and touch his feet. Your appearance is not independent. So your independence has to be both in fact and in appearance. Also the other way around also cannot happen. Before you start the audit, you talk to your uncle that, see, from tomorrow I'm going to come to your office for audit. But because my team will be there with me, I will not be touching your feet. So please don't mind. Now it's the opposite way. You have already told him, there is an understanding that uncle, please don't mind if I don't touch your feet. But don't worry, I will issue a report that you want me to issue. So now what happens? You are in appearance, you are independent, but in fact, you are not independent. Okay. Again, I'm giving very simplistic examples here. We will look at many more complex examples also when we go to A6. But all I'm trying to say is that independence has to be both in fact and appearance. Professional judgment, I hope you have already made a page on that. When the auditor can withdraw or should withdraw from the engagement, I hope you have made a page on that, right? A110 module, A1 module 2, page 10. Then, in addition to gas, you may be required to complete the audit with other standards, but in addition to gas, not in place of gas, not instead of gas, but in addition to gas. And then why do we obtain reasonable assurance? Why not absolute assurance? Because of the inherent limitations of an audit. What are the inherent limitations? Financial reporting, nature of financial reporting itself, the nature of audit procedures, then timeliness and cost benefit considerations. Right? And then what type of engagement? For non-issuer, issuer, integrated audit, all that we covered. Objective of the audit. Right? So I think I went pretty slow today. Everything should have already been, captured in your head. But let me also tell you something, and I think I have mentioned this earlier, that whatever we learn, there is a statistic that whatever we learn, we forget 20%. We forget 20% within the first 24 hours. We forget another 20% within the first week. And we forget another 20% within the first month. This is a proven stat. So 60% of what we learn, it evaporates from our mind. So if you don't touch audit for a month, you will forget 60%. And 40% that will stay with you will also slowly fade out from your memory. It will also fade out from your memory with time. So what is important is this statistic also says that if you revisit what you learned within the first 24 hours, if you revisit what you learned within the first 24 hours, then it is going to stay with you for a long time to come. Long time to come. It will stay with you in your head, in your mind. If you revisit what you learned within the first 24 hours, that means whatever we have covered today, if you revise that today itself, before tomorrow 9 o'clock, within the first 24 hours, then you are going to remember it for a long time to come. It is scientifically proven. I am not making this up. It is scientifically proven. So please revise within the first 24 hours if you really want to benefit from the classes. Okay, thank you guys. Now I will see you straight on 8th of Feb. And of course, those who are doing amendment classes with me, I will see you tomorrow evening, 7 o'clock for the amendment. Thank you. Have a good time until we meet again. Bye.